Today on the Dynamic Growth Podcast, we're going to be talking about Home Depot and Walmart and their recent earnings, about how that could be a leading indicator for a recession. We're also going to be talking about the Bitcoin 2023 conference and the current state of Bitcoin. And lastly, we're going to be talking about China and how their stimulus and their prospects for saving the global economy from a recession may be coming in a little under expectations.
We're also going to be talking about a reversal on the war on cash. There's a new war out there, which is now the war on plastic. And we hope you enjoyed today's episode. If you have any questions at all about investments or your own portfolio, contact us at crosbyadvisory.com. For listeners who don't know, one of the things we do with this podcast is each of us, Derek and I, bring an element or something that we want to talk about, but the other person doesn't necessarily know about that. And I think it opens the door for both education and probably a better conversation. But one of the things you had mentioned, Derek, that you wanted to talk about was Home Depot's recent earnings call, which was less than stellar, at least compared to its history. So let's begin with that first.
Yeah, so Home Depot reported on May 16th, and they beat on earnings, but they missed on revenue. But the reason that people interpreted it as such a bad quarter is because they lowered forward guidance. They actually lowered guidance to the point where this year could be the first year of declining sales since 2009. Like since 2009, they've had increasing sales every single year. So a couple things to note, that is coming off a high point. So during COVID, that was one of the rock star stocks that everybody was piling into, because if you're staying at home, you wouldn't be as willing to put up with some of the the glaring flaws that are in your house, or you just have more time at home to maybe do some home repair, maybe put on a fresh coat of paint.
And more money.
Yeah, and yeah, if you got handed $2,000 in stimulus payments, you're like, what? This is a thing that's been annoying, and then you got some cash, and you're like, might as well fix it while I have the money. Some people are tying it into the prospects of a recession. Home Depot is a little bit more discretionary than something like Walmart, let's say, where it's like you need groceries to live. You don't necessarily need to fix your porch or fix your shed or paint again. So there could be an element of that. But I also want to talk about, one more thing about Home Depot is people aren't necessarily, a lot of times, or a big driver, and during the COVID years, I guess, we talked about this a ton on the podcast, where it's like the first thing you do when you buy or you're looking to sell a house is you might throw up a fresh coat of paint. And basically home sales have gone down significantly because of mortgage rates, essentially. So if you're locked into a 3% mortgage, you're basically going to have to downsize the amount of house that you're able to buy if mortgage rates are double from where you locked in on your house. So there's not as much buying and selling going on, and that would definitely impact the demand for some of Home Depot's products. But yeah, so I wanted to also tie into Walmart and Target's earnings, because that's kind of the more consumer staples side of the consumer balance sheet. And Walmart and Target had great quarters, stellar quarters. And I think you can probably, Home Depot might be a little bit more forward-looking than like Walmart and Target. Walmart's kind of seen as the the cheaper products and services. So if you're normally shopping at Kroger, let's say, or Whole Foods, and you're trying to shore up your consumer balance sheet or your budget, you might make the swap to start shopping at Walmart more often. That's speculation. There's nothing data backing that trend or anything. But
Actually,
that's just kind of some speculation.
Actually, I saw something in last year in 2022 that they said when inflation began to be a problem, and in July it creeped up to 9.1, and it said for the first time, households, a greater number of households with combined income of 100,000 were doing their grocery shopping and their consumer goods shopping at Walmart. So it did bleed into some of the higher, and it wasn't just the lower income housing. It was the mid to upper housing that made a switch in how they were purchasing their groceries and the consumer goods.
Yeah, for sure. So inflation definitely impacts the marginal buyer. So let's say you're on the edge where you can like shop at Whole Foods, let's say, and then as your purchasing power gets hit, there's going to be people on the margins that kind of like get pushed over into maybe needing to shop at Walmart for some of their stuff rather than just not really concerned about their grocery budget, for instance.
Yeah. And just because somebody has a high income doesn't mean that there's a lot of wiggle room in their purchasing, right? Because you could have a high income and you could be leveraged out to the hilt. And if you start seeing some price increases in some of your basic necessities, that forces you to find better bargains out there.
I mean, or something as simple as just you have that variable rate mortgage and you were paying $1,000 on your mortgage payment. Now you're paying 15
Sure.
to $1,800 on your. I mean that's gonna impact your personal budget as well. I think there's a lot of stuff going on, but I mean this is one of the reasons why we've been so vocal about our belief that consumer staples, like the more defensive style factors, are going to outperform, even though we've been wrong in the first half of the year. But we still hold that view for the back half of the year. If we are right about our prediction that there's a likelihood of a recession in the back half of the year, these types of plays are going to be able to outperform the high valuation tech stocks that have done extremely well year to date.
Yeah. Before we move on, I did want to touch on Home Depot. We've talked about this on the podcast before. We talk about Home Depot quite often. I think Home Depot is a stock, in my opinion, that you could place in there with Apple in the sense that you own it, you buy it, and you hold it.
Yeah.
And you hold it.
We were talking about this yesterday.
Yeah, for as long as you can. Home Depot is a stock that I think the payout ratio, I was looking at it a couple of days ago, the payout ratio for that dividend, which is up near 3%, is somewhere around a 34% payout ratio, which is fantastic. That's a payout ratio that you would expect Home Depot to be able to continue to pay for a long time, even if they do face some contraction in their earnings. I know that they were concerned the same-store sales, they believe were going to potentially fall. Same-store sales number that they look out, and that's really what a retailer will look out is the same-store sales, because you can increase sales by putting out a bunch more stores, but how efficient, how productive are the stores that are already in existence? That's one of the figures that you're going to look at. You had mentioned that they haven't had a miss since 2009. I saw data that went back even further than that. I think if you look
they've missed on like earnings and revenue, but year over year the sales numbers have always been better than the preceding year.
Yeah, I mean, what happened the last time that this happened? Home Depot has been a market-beating stock for that period of time. I don't think anything is wrong with Home Depot, the corporation. I think what we're seeing is, to your point we just stated, COVID happens. You've got an influx of money that comes in that people have in their bank accounts. There's only so many grills you can buy. There's only so many patio furniture items that you can buy. There's only so many coats of paint that you can put on. And if houses are not selling like they used to, that's going to decrease it a little bit. I think what we're probably seeing is expected. And I think that's why the stock has reacted as it has, meaning that it sold off a little bit when that news came out. But for the most part, it's not what you would expect it to sell off. And I think that's because the average investor who's buying Home Depot is not buying it for the next quarter. They're buying it as a staple that they can hold in their portfolio for years to come.
Sure. Yeah. I just wanted to reiterate your point because it's a great point that there are some stocks that the only mistake you can make is trade them. It's like you just buy them. You just buy them. Like they're just so well run. Like Apple is the prime example where it's like if you look at the history of Apple, the only mistake you could have made along that entire track record is selling. Like that's the only mistake you could have made because it's always beat because it's probably the best run company in the world, or at least one of them. And so there's a list of stocks that you just don't trade, and I would put Home Depot into that list. You'd probably look to put Walmart in that list as well. Coca-Cola, like the Warren Buffett type companies, where they're extremely well run, positive cash flow. You could argue that sometimes the multiples get a little stretched. I know Home Depot's multiple got stretched last year. Apple is a tech stock, so in the earlier days, I'm sure that the multiples got pretty high. But I just think Home Depot, like we just sing the praises of Home Depot all the time because it's a really well-run business and it makes a lot of money.
Do you know what I'm interested to see? So when Target had its earnings call, one of the things it pointed out was the amount that it lost. Every store has what it calls shrinkage, and that's essentially a product that disappears. And so Target specifically noted in their earnings call that they have had a large instance of violent events in their store, which led to violent criminal events, as I believe what they called it. Basically, people stealing their stuff, organized crimes stealing their stuff, planned people going into shoplift events. And they said that that was going to have a significant cut into their profit margin. I'm wondering if other stores are going to be as vocal about this. Meaning, obviously, this is not just happening in Target. You're having nationwide. You see pictures of
Walgreens
people.
is another one specifically. For some reason, it seems like Walgreens is often a target for this type of stuff.
Yeah, right. And so I'm wondering if other stores get on board and maybe shine some light on this as measures, to kind of up the cry for measures that need to be taken in order to protect those goods. Because obviously that leads to price increases for you and me.
Yeah. So if you have to hire for security, for instance, yeah. I think the playbook that a lot of these companies have enacted are they enhance security. They have a security guard, or they like lock up all the stuff. You've seen pictures of stuff like that. These are pretty isolated examples. It seems like it's happening a lot in specific areas, but it's not like a widespread problem where it's happening every single Target store.
Sure.
So recently, you've seen, I think Target's one of them, where they're just like, we're done here. We're just going to close the store because it's literally become so big of a problem that we can't even run the business here. So it's just beyond repair, and we're just going to like close up shop. So I mean, you could see that in some different retail locations. But yeah, the fact that Target said, I think it was like $500 million in losses due to theft, like that's such an astounding number. I mean, think about you're shopping at Target. So, I mean, and then again, we're not talking about every single Target in the United States. We're talking about isolated incidents. So it's like, think about the volume of stuff that would have to be stolen to make up $500 million in goods. It's such an astounding number. It's insane. Yeah,
agree. All right, what else we got?
So we can talk about. Let's close with China. So this week the Bitcoin 2023 conference. Since we weren't invited to be speakers at the conference, I just wanted to give my thoughts on the current state of Bitcoin.
And that shocks me actually.
Yeah, I know, right?
I think you might be Bitcoin's maybe greatest proponent out there, talking about it quite often, about its merits, and so I would think that you would be a prime candidate for that.
Yeah, right. Maybe someday. But I think Michael Saylor stole my spot. He's a little bit wealthier than I am. But so did you have any thoughts? I know it just started today. You've probably been pretty busy. You haven't been following up on it. But did you have anything about, or any current thoughts about the state of Bitcoin?
I do not have anything specific. I will say that Bitcoin has surprised me in the sense that Bitcoin as an asset would be considered a risk asset, I think. I think that's safe to say,
Definitely.
Right? If anything, only because it's new. It's a new asset out there, still in its infancy as far as what it will be, what it can be. And so when things get a little scary, those risk assets tend to be the items that are sold off first. I'm actually impressed with Bitcoin for its performance this year. And maybe I shouldn't be, because if I look at other risk assets, look at the NASDAQ, for example. The NASDAQ is leading the three major indexes this year. And in January, if you'd have told me that, I would have found that hard to believe. So maybe it's not a coincidence that Bitcoin has had its run that it has so far in 2023.
Yeah, the big surprise for me was an extension of what you just said, but with the bank failures. Like every time a bank fails or there's news of a bank failure, Bitcoin runs up like crazy. Like, I understand from a Bitcoiner's perspective why that would happen, but from an institutional investor's perspective, like, it would be more along the lines of what you were talking about, where these big players in the investment space have a risk budget. Like, they have a certain amount of risk, like units of risk that they can allocate. And if they wanted to allocate towards Bitcoin, that would be the riskiest thing they could allocate to. So as things get riskier, like in stocks, let's say they have a regional bank portfolio, they would have to take from risk elsewhere. And then usually the first thing that they take from is like the riskiest thing in their portfolio, which would be Bitcoin, or if they had other crypto assets, if it's like a crypto investment firm or something like that. But so that was actually really surprising to me. But it's actually, as a Bitcoiner, it's actually really cool to see that, because it plays into the thesis so well, but it kind of takes like an understanding of Bitcoin to explain why Bitcoin would do well when the banks are failing. So that was one thing that definitely caught me off guard this year.
Yeah. When you see banks are going out of business or going into receivership, regulators stepping in, consumers tend to move money to cash. They tend to move money to gold, move money to treasuries historically. And now they have an option to move money to Bitcoin if they feel that that's a safer option for keeping their money out of the exposure for the banks. Now, it's important to keep in mind, I think these banks that have failed, the number of depositors that were over the FDIC limit was actually substantially large. And I think that
especially with Silicon Valley. Valley Bank was like over 90%. Yeah.
So I think that made those banks particularly interesting because we didn't have, most of the people were not made whole. At least not by the FDIC insurance.
Yeah, I think so. Like if the banks get bought out, that's been the playbook. Like JP Morgan comes in and buys your bank. They just kind of like take over the assets essentially. I don't know. I haven't really followed up about I believe all of the depositors at Silicon Valley Bank, like none of them lost money, even though in my opinion, I think a lot of them should have lost money because they were given preferential treatment. Like if you have $1 billion at that bank, you're incentivized to keep $1 billion there. I think we talked about this on the podcast before, where like if you park $1 billion here, we'll give you an interest-only mortgage, so you can get your multi-million-dollar home, and you have to make minimal payments on it. Basically, they're giving you the money for free, and then it's like, okay, you can do that. I have no problem with that. But then, like, you're putting that much money in one bank, you're taking on a certain set of risk, and it's not it doesn't fall on the average person to bail you out if that risk comes back and bites you. I just don't agree with that, because like we talked about with some of the companies that were in Silicon Valley Bank, like they had just ungodly amounts of money. It's just like, it's a very easy issue to sidestep. You could go buy treasuries, you could put it in a money market, you can do so many different things. It's like, it's not on the average everyday person to bail out a company with hundreds of millions of dollars in the bank. Like, that doesn't make any sense to me.
Yeah. Didn't Roku have like something like 950 million in Silicon Valley?
It's something crazy. Hundreds of millions. Yeah.
So
that's crazy.
It does become a little bit more difficult when there's that much money, right? Rather than, obviously you can't have a zillion accounts out there and keep track of them. So you probably are taking some risk in some of the things that you're in, but yeah.
Yeah.
So what's new with Bitcoin though, is there anything new coming that might enhance its features or make it more appealing?
Yeah. So this is what I wanted to talk about. So, there is some stuff that's kind of like that people are talking about with they're called ordinals, where people are basically like inscribing certain images on the Bitcoin blockchain, kind of like NFTs, but they're not exactly like NFTs. So these are kind of the new technological developments. But the point being is that I don't think any of the new developments matter. It's because like I don't think the main value proposition for Bitcoin is you get faster, cheaper transactions. I think Venmo, Cash App, I think that stuff works perfectly fine. I think the real value proposition of Bitcoin is the like kind of the restructuring of the monetary system. It actually has the capability to do that, and it like decorrupts the money and kind of like circumvents the Cantillon effect, which was something that we talk about, where the people that are closest to the money printer get all the benefits of QE first, and then like the middle, lower income people get the impacts last. But then by the time those benefits trickle down to them, we have an inflation problem, and then we have to do QT, and it hurts those people first. And then the people that have their assets run up 5x, like they're kind of immune because their assets have run up so much. It screws the everyday person. And I think like Bitcoin is actually able to like restructure everything if you restructure everything around sound money. And I don't think that just because you have a better user experience compared to Cash App, I don't think that's what's going to drive long-term, or what's going to drive Bitcoin's value long-term. I think it's going to be that much more valuable thing of like actually fixing a really big problem that has never been able to be solved because if you have access to the money, it's such an ungodly amount of power that it corrupts everybody.
Do you know what I think the Bitcoin community needs to combat, and that is maybe just education as far as when you think about Bitcoin, you think about extreme volatility. You think of Bitcoin running from $65 or 65,000 a coin down to 15 or 17 or wherever it was at. But if you look at historically other precious metals like silver, and we've talked about this in the past podcast, you could do a back test of silver and see that it has a max drawdown of over 70% in some years. So those precious metals are not like they're rock solid stable either. And so, but I think because Bitcoin is a digital currency and nothing that you're going to keep in your safe or hold in your pocket or hold in your hand, I think the volatility scares people a little bit more.
Yeah, I think the volatility is going to be it's going to be like a hindrance for some like retail investors to get in, and definitely some big money entering the space. But I mean, I always say that like volatility is not inherently bad, because if you look at the back test, like if you're concerned about volatility, it's that example that you gave about the bell curve with the S&P. It's like, well, how long have you been in? Like, are you trying to trade it, or are you just owning it? Because if you just owned it, I mean, if you bought it at 65,000, obviously you're down. But I mean, if you held it for 4 years and then even longer than that, like you're up dramatically from where you bought it. So I think the swings are an issue if you're trying to convert all of your net worth to it and you're seeing these big swings in your net worth on the short term. But I mean, it's the same thing with stocks where if you're saying volatility itself is bad, then don't own Amazon stock, don't own Nvidia stock, because I mean, those are just two extremely volatile stocks that have drawn down over 90%, like in the early 2000s during the tech bubble. So if you're really concerned about volatility, don't own that stuff either. Yeah, I guess that's probably where I would leave that.
Do you know the one frustrating thing about Bitcoin? I've used Bitcoin to make 3 purchases in my life, 3 or 4. Every time I've used it, within the next week, it's run up substantially. So what I actually paid for that product, when I look at the lost opportunity cost, was
super expensive.
Pretty substantial, yeah.
Yeah, I got paid for a website in Bitcoin one time, and I forget what let's say it was like $800 I charged, and then like the amount of like if I were to sell all that Bitcoin that I got paid back then, I would be still up quite a bit. So I mean, I got paid. That was probably the most expensive website that I built.
So let's get into China.
Okay, sure. Okay, so this past week, China retail sales is what a lot of people have been talking about. So there was kind of this theory at the beginning of the year, I guess late last year and early this year, that the China reopening story was going to be the thing that saves everybody from this global recession that was coming, and they were going to come out of this the COVID lockdowns and stimulate to just like really make sure their economy opens up strong. And that's kind of coming in a little bit under expectations what people need it to be. And it probably need to exceed expectations to really have a chance at pulling the global economy out of this recession that's probably going to happen later on this year or early next year. So keep in mind, these numbers are comparing to last year's numbers, which are at a low point because the entire country was shut down. So industrial output printed at 5.6% when 10.9% was expected. So pretty lackluster there. And then retail sales is the big one. So they had 18.4% growth in retail sales, and there's 21% expected. So yeah, on its face, 18% sounds good, but remember, it's judging from a low point. So the thing that I would say looking forward is the Chinese government could definitely do more to stimulate, because the dollar has gotten weaker this year, and it kind of gives them more clearance to debase their currency essentially, because they are an exporter, and if you're an exporter, you want a weak currency because that helps your countries in your economy that export goods, and it works and vice versa as well.
Yeah. We had talked about a couple podcasts ago, you did a series on the health of the dollar. Where is the dollar as the global reserve currency and what its future looks like. And we talked about, in order for there to be another global reserve currency, one of the aspects of the global reserve currency is that you need it to be fairly stable, right? And so some people are worried, well, well, people start moving to Chinese currencies or a combination of Chinese and you name it, right? I think BRICS is one of them out there that is an acronym for a number of countries there. But I don't know if China's continuing to play that game where they intentionally artificially devalue their currency. It's going to be interesting to see how other countries put up with that.
Well, I mean, we do it too. Like, I mean, it's just like whether it's fiscal policy or monetary policy, like QE or something. Like, it's something that all central banks choose to do. It's just that, like, people were expecting, like, with all the stimulus that they were planning on doing, or at least that everyone thought that they were going to do, they just thought it would have a bigger effect on the real economy, and it just didn't.
I think
yeah, go ahead. Sorry.
I would say I think the difference is I agree with you, but I think the difference is with the United States and some of the other developed countries, it's a little bit more transparent as far as what the fiscal monetary policy is.
Sure.
And I think
also the metrics that people are using to evaluate the economy. Like, I mean, because China will, like, nobody really trusts them. They really, like, I mean, they talk about all this gold that they buy, but it's not audited. I mean, to be fair, ours in Fort Knox isn't audited either. But like, just because of the nature of they play their cards pretty close to the chest. They're just less trustworthy than a lot of, like, the United States, for example. So, point well taken.
And somebody might say the United States is not trustworthy either, but at least it's you could get the information. It's fairly open as far as what you would want to see as far as
the cleanest shirt in a dirty hamper. Exactly.
Yeah,
right. So the counterpoint to they could stimulate a bunch more would be this debt ceiling debate that is going on in the United States. So the U.S. Treasury, I believe, we're recording on Thursday the 18th. I believe the U.S. Treasury has $52 billion in reserves, and I believe yesterday they spent like 50 billion. So I mean they're really cutting it close to the wire. They're really dwindling down the TGA, the Treasury General Account. So presumably they're not going to default on the debt. I don't think anybody has that as a significant percentage chance of happening. I think nobody's really incentivized to default on the debt. That would basically be Armageddon for everything, for all financial assets, and then the trickle down would be, I mean, it'd be Mad Max pretty quick if the U.S. defaulted on the debt. So when they get this debt ceiling debate all buttoned up and everything, Janet Yellen has said they're going to drive that TGA, that Treasury General Account, back to $500 billion, I think is the level that Janet Yellen likes to keep it at. So they're going to issue a bunch of treasuries, and that is basically going to force actors in the economy to buy those treasuries. So that's going to be pulling liquidity out of the system, and that basically is a bull case for the U.S. dollar. So, I mean, if we're looking at China, they want to be weaker relative to the U.S. dollar. They don't want to be like way weaker. That's the thing. It's kind of a balancing act where they don't want to be like a worthless currency that they just keep debasing. So that could be a potential headwind for the stimulus in China, is if there's a big run up in the U.S. dollar, which I think it's a pretty compelling case. I think that's if we do go from 52 billion to 500 billion in a pretty short time frame, I think that could cause a kind of pullback in stocks, even because, I mean, stocks in the U.S. dollar have been inversely correlated last year and this year. So that's something that's on my radar, and I would definitely look out for.
So if you are an investor, are you making a long play into China right now?
I don't know about China, but potentially the U.S. dollar. I think the UUP is something that we're probably not going to add because of just the tax reporting on that. That ETF is a nightmare. But but if you're an individual investor and don't care about some extra paperwork on your taxes, UUP could be a decent place to play that. I haven't put on that position yet, but I mean, something that you could look into. I mean, do your own research. Don't make that decision just on this podcast.
And that extra tax reporting that Derek's talking about is called a K-1 that you get typically much later than you would anticipate. A lot of times you don't get a K-1 until sometimes in April.
Yeah, right.
I mean, right before you should probably file your taxes. A lot of times people get it afterwards and they have to make amendments to it. So unfortunately, yeah, there are some things.
It is the cleanest way to play an appreciation in the dollar, unless you have like a bigger tool chest. Like if you're a big bank or something, you can do some different types of stuff. But as far as retail investors go, you're kind of limited in how you could play that.
Anything else with China?
No, I think that's all I had.
I wanted to talk about, so you came aboard somewhere around 2019, 2020. And we were talking about the early podcast that we did. We would talk about the war on cash, and we would talk about the payment services like MasterCard and PayPal, and how those were set up to basically have a tailwind here, because the world for the past 10 years, 15 years, 20 years, actually since the 80s, we've been moving as credit cards have come into existence as you've got Apple Pay, you've got debit cards. People have been moving away from cash. And 5 years ago, if you were to walk up to somebody who was under the age of 30 and you'd say, hey, how much cash do you have in your wallet? Chances are they would have little to none, because they were holding it in their debit card or whatever. But what is interesting to see if you look at the trends, and the sources of this would be Nationwide Building Society, which is a big financial institution. It's not technically a bank, but they call it a building society, which means its members actually own it, but it operates as a bank for the most part. This is in Great Britain. There are studies looking at Bank of America, looking at surveys from Credit Karma, from the Harris Poll. All of these are showing significant increases in cash withdrawals and cash used as transactions since COVID. And I kind of wanted to get into why that is. Obviously we've had a problem with inflation, and Great Britain has had a worse case with inflation than we have here in the United States. So they were, if you do a Google search and you just typed in movement back to cash, you're going to get a ton of articles that come up. And the oldest articles would have been published by the BBC, and they're talking about some of the constraints that the people in Britain, as their energy costs and their heating costs and their food costs skyrocketed through the roof, they were literally counting pennies. And so you remember the old envelope system for getting out of debt, where you get paid, you take that payment and you put it into cash, and you have your basic needs like your shelter and your rent and your food, your utility bills. Those are all going to that necessity file. And then your entertainment file for eating out or going to see a movie or something like that would go into its own envelope. And at the end of the month, if you've used all that, or halfway through the month, if you used all that, then you're done. It doesn't go onto a credit card. But people are moving back to that. And that's the number one reason why they cite that they've been using it. And to give you an idea here, so that Credit Karma and the Harris Poll, in March of this year, they did a poll and they showed that 53% of adults in the US and 46% in the UK, which actually shocked me. I thought UK would be higher than the US, use more cash than they did a year ago. And they're using these cash for transactions. The number one reason would be it's harder to spend cash. So if I have a problem of going into debt, handing over that $5 or $10 bills, which actually I can feel it and I'm handing it to you and I have to make change out of it, is a lot harder than tapping my credit card on that. The other thing is, have you noticed, Derek, one of the other things that they cited was, so you go into a store and you're going to buy goods, whatever those goods are. You hand them your credit card, they hand you that tablet and they turn around to have you sign it. And one of the options on there is a tip, right?
30%.
Yeah, that tip could be 5, 10, 28, 30%, whatever you want to add on to that. So some people have a problem with that, meaning that...
I have an interesting insight on that, by the way, that continue with the story and we can come back to it.
No, we can go back. My point is so you're standing there and the vendor is also standing there looking at you, waiting for you to make your selection. Some people feel obligated to leave a tip, even though the person didn't really do anything. I walked to the shelf, I grabbed what I wanted, I brought it to the checkout counter. So cash is a way to avoid that, right? If I pay in cash, I'm not forced to make a tip.
Yeah, that's interesting. So I was listening to, I was like a YouTube video or something, and they were like explaining this. So like, it's not the individual businesses that are like, oh, let's get our employees extremely well paid. Like we want them to make more money via tips. It's the actual like Square payment processors or whatever payment processors they're using. They get a tiny percentage of every transaction that takes place. So they're just trying to incentivize more dollars going through that Square payment processor, the point of sale thing. So I mean, if you're getting an extra 30% tacked on the bill, then this point of sale machine is also getting 30% higher transaction fees on that sale. So I mean, when I heard it like that, I'm like, oh duh, that makes so much sense. But I mean, you think it's just like the craziest thing to me is two things. One, where it'll start at 20. Like, so let's go back for a second.
Sure.
It used to be 20% was like stellar job. Good
a
job.
generous tip. Yes. Yeah. You did awesome.
So now it starts at 20% for like if you pick up a coffee. Like you didn't even like you already paid for the coffee. Built into that cost of the coffee is like what the management pays the employees, and then you have to pay 20% on top of that. So now it starts at like a pristine tip on top of inflation. We'll leave that aside for a second, and then it goes all the way up to 30%. And then the other thing that drives me crazy is they will invert them. I don't know if you've seen this.
Yeah.
Where normally it's like 15, 18, 20, but now it'll be like 20, 18, 15. So like you just click the leftmost one, and then that's actually the one with the highest tip.
Yeah.
It's just like the scammery involved of trying to like extract more money out of consumers just drives me crazy. Not that I have anything against tipping, but I do kind of have something against tipping when it's not warranted. Like tipping for tipping's sake is it's getting a little out of hand, and I think a lot of people are kind of getting tired of it, to be honest.
Yep. And so that appears to be why a lot of people are moving back to cash so they can avoid that. The whole movement of the war on cash was a frictionless transaction. And we've talked about this. Some of the benefits of having a frictionless cash system is not only can you tap it, use your Apple Pay or however you want to pay with it, you can transfer with Bitcoin, but the ability to move cash in various forms, meaning to transfer to Bitcoin to back to cash. You could use your card to make cross-border purchases, and that's actually one of the things that hurt companies like MasterCard and Visa during the COVID shutdown was that they get extra fees for these cross-border purchases, and those weren't taking place when people were locked in their homes. So everything, the war on cash was basically advertising a frictionless transaction. Well, it turns out that a frictionless transaction might be great if you're a payment service, but it might not be good if you're looking at your net wealth. If to your point, we were talking about car washes earlier today, and you had said there's a car wash where you're at where it's a membership. I've never even heard of this. It's a membership service to the car wash.
There's a bunch of them around here.
So I thought it was interesting when I could go to the car wash and I could use my debit card or my credit card to pay for instead of the coin. If I'm a car wash owner, I actually want you to pay in coins, I would think. We won't get into reasons for that, but it's a cash business, right? So
yeah, right.
But I would think that you would probably want to avoid people. But to your point, this blew my mind. A subscription service to the car wash. There's no way, Derek, that I would wash my car enough in a month to make up for that amount. At least I don't think. That's me personally. Now, there's probably people that wash their car every day.
My dad like literally washes his car all the time.
So again, frictionless transactions. And so in a situation where money is tight, inflation's a problem, that frictionless transaction maybe is not your friend. Maybe you want to actually make that transaction a little bit harder on you to force yourself to keep some of that money in your pocket.
Yeah, especially from a budgeting standpoint. Like this is a point that Dave Ramsey actually makes, and it's legit. Like where one, he always talks about how like if you go into Home Depot or something, you're going to buy a lawnmower and it costs $6,500, and then you walk around with $6,000 in cash in your hand, and you're like, can I do this for $6,000? Maybe not with Home Depot, but like maybe like a local hardware store or something like that. And they're like, no. And then you're like, okay, have a nice day. And then you walk out. They're like, wait. I want to sell that lawnmower for $600, and he has cash right there. Sure, yeah, I'll take that deal. But if you have a debit card, they're not gonna do that. And then so cash, you feel it right when you spend it. It's like you can actually feel the money leaving your hand, and you're like, do the mental math about how much money you have subtracted. And then when you do a debit card, it's a little bit less because, I mean, it's just tapping plastic.
It's not really. It's not real until you actually get the bill.
And then credit cards would even be a step further where it's not even your money. So it's like, I'm just going to tap this plastic to a screen, and it's not even my money until you actually make the payment on the credit card. So that's like one of his reasons why he's like anti-credit card is because there's less friction with the credit card than there is with actual cash.
Mm-hmm. One of the things that we're seeing is, and this will be interesting to see how this plays out, we have talked about So with inflation, some of the thoughts is that we might have this sticky inflation, meaning that it might remain elevated for a longer period of time than people expect. And we might not get down to that 2% target that Jerome Powell would love to see. And there's a number of reasons why that might be the case. One of them is the idea of reshoring, meaning that we had this push towards globalization for a long period of time. And one of the things that globalization did is make the cost of goods lower. Because if I can go produce my product somewhere else in a country that has lower labor cost, lower production costs, then I can sell my product for less. And that was working out great until COVID happened. And people realized that we couldn't get goods in from China and we couldn't get things across the sea. So one of the things they looked at is bringing the manufacturing back home, or a process that's called nearshoring. So maybe I don't actually have it produced in the United States, but I have it produced in Canada or Mexico. Where I can drive a truck to pick it up. So I was listening.
Yeah, totally.
No, I was listening to an article, an interview actually, with a guy by the name of Harold James, who's a professor of economic history at Princeton. And he was looking at the last 5 to 7 financial crises that we had. And he basically said all of them drove the world towards greater globalization. And it was his stance that the COVID downturn or the COVID lockdown would actually lead to the same. And I just found that interesting because the data
lead to more globalization?
Yes, more globalization.
Okay.
And I just found that interesting because, and maybe long term, maybe that's true, but it seems in the near term, all the data that I'm looking at, and anecdotal conversations that I'm having with business owners there's a business that we serve here that purchased a plant in Mexico for that reason, so that they could get their products. They could, if need be, they could drive a semi and pick it up. There's a firm out there, a consulting firm out there called Kearney, and Kearney produces the Kearney Annual Reshoring Index, which basically looks at our manufacturing jobs leaving or exiting the country. And if you look at the history of that over the past, since COVID, it's a sharp uptick as far as the amount of jobs that are being brought back to the United States So I would, he's from Princeton, right? He's smarter than I am, but I would, the data that I'm looking at doesn't show that to be the case. And if that is the case, if we are bringing back jobs to the United States, that's probably going to mean higher labor costs. So that might mean higher sales costs, meaning inflation could stay here for a little bit longer than we expected.
Yeah, this is something that Lynn Alden talks about a lot, is the kind of like extrapolating out, like COVID was such a monumental thing that happened. So like extrapolating out like the next 10 years, like what does this look like? So part of the reason why the Fed has been so adamant about not 3%, not 2.5%, not 2.1%, 2% inflation is because let's say you get it down to 2% for a second, and then you're like, okay, the hard times are over, and then we're going to go back to easier policy. It's just going to shoot right back up to like these higher levels. So that's what people talk about when they're talking about entrenched inflation. It's just like the base effects pull it to a higher level than where they did in the previous decade, which is around 2%. It used to be a fight to get inflation to 2%. They would used to debase, because there's a lot of reasons why the government doesn't want deflation. Deflation is actually worse for them because, I mean, a good example is like the debt. If you're in deflation, it's harder to get dollars. So if you borrowed dollars back then and now it's harder to get dollars, it's harder to pay back loans, for instance. That's why they don't want deflation.
Does the government plan on paying back loans?
Well, they plan on paying the minimum payments, I guess.
I got it.
But so yeah, in the previous decades, it was a fight to, like, we didn't have enough inflation because the base effects were like pulling it to a lower level. But now, like all the stuff that happened with COVID, with the supply chain bottlenecks, or all this stuff with reshoring, like the base effects could be pulling it to a higher level now, and that's a big concern about if we have entrenched inflation over the next decade or the next 2 decades or something like that. That causes a whole host of issues in asset markets, but also supply chains in a bunch of different areas.
So let me ask you, are you carrying more cash than you usually do?
I plead the fifth.
Okay. I have actually, in my situations, unique. I actually have a hard time doing cash because,
A lot of places don't take it anymore.
well, not, but there's a big thing on social media right now that are essentially attacking businesses that don't take cash, shaming them and bringing them out and showing people will give you alternatives where you can go to their competitors and actually use cash. I have a hard time using cash because a lot of the transactions that I make are for the business, and I can't make cash transactions for the most part because it's got to be regulated. It's got to be audited, and people got to see where the money's going.
Sure. Like I'm thinking of like one of our, we use like Zapier, so it's like write Zapier a check or like send them cash in the mail or something like that.
Right.
Like I mean, all of the products that we use or all the services that we use for like streamlining the business and making us more efficient, they're all digital. They're all digital now.
Interesting. It'll be interesting to see if this is a trend that continues, especially. So I won't beat a dead horse. Another of the reasons why people are moving to more cash, as at least they stated in the survey, is the uncertainty with the bank failures. Meaning that if you have concern about the health of the bank, which you're keeping your money, you might tend to keep more in your house.
So I said I plead the fifth, but I'll give a teaser. I do have more cash, and a big factor of that was the bank failures, because I keep cash in a regional bank, and I've been encouraging all my friends to do the same thing. If you're not in one of these big banks, I mean, even if you don't have if you're not over the $250,000 limit, I mean, so the FDIC has a finite amount of cash that they have, and let's say this is not going to happen. Like this isn't like it's a small probability. Like this is not going to happen. But let's say the Treasury runs out of money on June 1st. And then all of these banks fail next week. The FDIC is going to run out of money and the Treasury can't raise more money. It's like you'd be screwed. And then they would probably have to rush to do the debt ceiling. And you might not have money for like a week. You just don't want to be in that position when it's a very easy way to sidestep that issue and just get some cash out. Put some cash in a safe, or put some cash buried in your mattress or something.
Sure.
But it's just a very simple thing you can do to sidestep a potential hazard. But I mean, yeah, it's not going to happen this time around. But it's just like that's just one scenario where you just don't want to be in. It's super easy to sidestep.
Oh, you should always. I mean, if you look at your financial plan, you should always plan for the unknown, and the unknown just means
a small allocation to stuff with small probabilities. Yeah.
Absolutely. Well, Derek, interesting stuff. I really liked your piece there on the dollar with China. That's something that I think that most people probably don't get into that depth on in thinking about that relationship and how the economy works and the relationship between stocks and the dollar. And so I appreciate that. Is there anything else that you'd like to add?
As always, thanks everybody for listening to the podcast. If you enjoyed it, like, share, subscribe wherever you get your podcasts. Follow us on Facebook, Instagram, LinkedIn. Watch clips from the full podcast on YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we'll see you guys next week.
Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Florida, and Texas. At any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific investments, and that is not a recommendation for you to buy them or sell them. Do your own homework and make sure they are suitable for you. Keep in mind that investing is a process that involves risk, including the potential loss of principal.